Okay, here we will be continuing our discussion of topic 958 and subtopic 20, financially interrelated entities. And up until this point, we have discussed what types of entities are considered to be financially interrelated and therefore fall within the subtopic, and that was in the scope section. We've also determined how to recognize transactions between financially interrelated entities and also subsequently measuring those transactions. For instance, at the end of the period, what should the balances of the accounts be for financially interrelated entities. And now we'll look at other presentation matters. And this basically kind of builds upon these other sections and sort of gives us a high-level summary of how things should be presented at each period end. And first we'll look at equity transactions. And before we get into these, I'd like us to go back to section 25.4 where it describes what an equity transaction is. And once we kind of review and refresh our memory on this, it'll be better able to understand the other presentation section. So remember that transfer of assets to a recipient entity is an equity transaction if the resource provider specifies itself for an affiliate as a beneficiary, if the resource provider and the recipient entity are financially interrelated entities, and there's no expectation that the transfer of those assets should be paid back. So in our chain of entities from the donor to the recipient entity to the beneficiary, if the beneficiary sends some assets up to the recipient entity, then that might be an equity transaction if it's not expecting those assets to come back. So basically this other presentation section that we're going through right now explains how to present that type of transaction. So we have here that the recipient entity should report an equity transaction as a separate line item in its statement of activities. So let's say it receives some assets from a beneficiary entity that it doesn't have to pay back to the beneficiary. Then it should record maybe a below-the-line revenue item. And it doesn't really give us any specifics here, but we could maybe name it something like increase of assets from equity transaction, something like that. And also it says the resource provider, that's the beneficiary, it should report an equity transaction as a separate line item in its statement of activities also. And so it might have something below the line that says something like transfer of assets to recipient entity as an equity transaction, something to that effect. So a common theme for both the recipient entity's financials and the beneficiary's financials would be that these are recorded in the statement of activities and not necessarily as in the net assets section, which would be the case if these were for-profit entities. And the next section is beneficiary's interest in the net assets of a recipient entity. We remember in the prior videos, if the recipient entity has received assets from a donor that are intended for the beneficiary, then the beneficiary should record an asset account that is an amount of the interest in the net assets of the recipient entity. So what amount of the recipient entity's assets, net assets, are intended for the beneficiary. And so basically on the recipient entity's financial statements, they might have an asset account that contains the assets that are received from the donors, maybe cash, maybe some kind of fixed assets, investments, something like that. And on the beneficiary's books, they have this asset account that's called an interest in the net assets of a recipient entity, almost sort of a receivable account. So this section tells us that whenever the beneficiary and the recipient entity are consolidated, and we'll go through the requirements for consolidation later on, but when these two entities are consolidated, then those two asset accounts need to be eliminated. And so basically in the consolidation, the beneficiary's account that is interested in the net assets of the recipient entity would be removed, and the only thing left would be the actual assets that are owned by the recipient entity. And this is described in more detail in the subtopic 8.10 about consolidating financial statements.